Before we begin to think about what is financial risk, we need to understand first what risk actually is. So, what do we mean by the word risk? Well, risk is the effect of uncertainty on objectives. Risk is any deviation that may occur from what is expected. So let's proceed. What is financial risk? Financial risk is a type of danger that can result in the loss of capital to interest parties. It refers to the additional variability of earnings per share and the increased probability of insolvency that arises when a firm uses fixed cost sources funds such as debt and preferred stock in its capital structure. So, when we say insolvency occurs when a firm is unable to meet contractual obligations such as interest and principal payments on debt, payments on accounts payable, and income taxes as they come due. Fixed capital cost represents contractual obligations a company must meet regardless of the EBIT level. The use of increasing amounts of debt and preferred stock raises the firm's fixed financial costs. This in return increases the level of EBIT that the firm must earn in order to meet its financial obligations and remain in business. The reason of a firm accepts the risk of fixed cost financing is to increase the possible returns to stockholders. What is financial leverage? So, when we say financial leverage, it is the use of debt to buy more assets. It causes a firm's earnings per share to change at a rate greater than the change in operating income. For example, if a firm is 100% equity financed and EBIT increases or decreases by 10%, EPS will also increase or decrease by 10%. When financial leverage, such as long-term debt, is used, a 10% change in EBIT will result in a greater than 10% change in EPS. This illustrates the concept of financial leverage. Line A represents the financial leverage used by a firm financed entirely with common stock. A given percentage change in EBIT results in the same percentage change in EPS. Line B represents a firm that uses debt or other sources of fixed cost funds in its capital structure. As a result, the slope of the EPS-EBIT line is increased, thus increasing the responsiveness of EPS to changes in EBIT. As can be seen in the figure, a given change in EBIT yields a larger change in EPS if the firm is using debt financing than if the firm is financed entirely with common stock. It is also clear that the use of financial leverage magnifies the return, both positive and negative, to the shareholder. When EBIT is at relatively high level, such as EBIT-2, Firm B's use of financial leverage increases EPS above the level attained by the Firm A, which is not using financial leverage. On the other hand, when EBIT is relatively low, for example, at EBIT 0, the use of financial leverage decreases EPS below the level that would be obtained otherwise. That is, EPS 0 is less than EPS 0. At EBIT 0, the use of financial leverage results in negative EPS for Firm B. Financial risk. Is it systematic or unsystematic? So, financial risk, like business risk, contributes both the systematic and unsystematic risk of a firm's securities. To the extent that the use of financial leverage magnifies variation in operating income that come about because unsystematic risk factors. It also contributes to the unsystematic risk of a firm's securities. Financial researchers also studied that the contribution that financial leverage makes to the systematic risk of a firm's securities. It is well established that systematic risk is a function both of financial risk and operating risk. Hence, security analysts and investors find the measurement of a company's financial risk to be an important element of a good financial analysis. effects of financial leverage in stockholder returns and risk. Firms employ financial leverage to increase the returns to common stockholders. These increased returns achieved at the expense of increased risk. The objective of capital structure management is to find the capital mix that leads to shareholder wealth maximization. The next slide will show the effect of financial leverage on stockholders' returns and risk on KMI Technology Inc. This illustration shows the effects of financial leverage on stockholder returns and risk, as shown in the example of KMI Technology Inc. KMI has total assets of $1 million. Suppose KMI expects an operating income EBIT of $200,000. If KMI uses debt in its capital structure, the cost of this debt will be 10% per annum. This table shows the effect of an increase in the debt to total assets ratio from 0% to 40% and to 80% on the return on the stockholders' equity. With an all-equity capital structure, the return on the equity is 12%. At a debt ratio of 40%, the return on equity increases to 16%, and at a debt ratio of 80%, the return on equity is 36%. KMI is earning 20% pre-tax on its assets. The cost of debt is 10% pre-tax. Thus, when KMI uses debt in its capital structure, the difference between the return on its assets and the cost of debt accrues to the benefit of equity holders. However, this increased equity return is achieved only at the cost of higher risk. For example, if EBIT declines by 25% to $150, the return on equity for all equity capital structure also declines by 25% to 9.0%. In contrast, at a 40% debt ratio, the return on equity declines by 31.25% to 11%. At an 80% debt ratio, the return on equity declines by 41.67% to 21%. The effects of a 60% reduction in EBIT to $80,000 are even more dramatic. In this case, the pre-tax return on asset is less than the pre-tax cost of debt. To pay the prior claims of the debt holders, the equity returns are reduced to a level below those that prevail under all the equity capital structure. In the case of a 40% debt ratio, the return on equity is only 4.0%, and in the case of an 80% debt ratio, the return on equity is 0%. Thus, it can be seen that the use of financial leverage both increases the potential returns to the common stockholders and the risk or variability of those returns. In this simplified example, we hold the cost of debt constant as a ratio of debt to total asset. Generally, the greater a firm's business risk, the less the amount of financial leverage that will be used in the optimal capital structure, holding constant all other relevant factors.